Stop looking at the red percentages on your trading screen. Stop obsessing over the 30% drop in paper silver prices that happened in the last 48 hours. Look at the silence in the Sierra Madre Mountains. Look at the empty engineering roster at Vizsla Silver. That silence is the sound of your high-tech portfolio starving to death. You think this is a financial correction? This is a supply chain amputation? While the Federal Reserve plays games with interest rates and the Chicago Mercantile Exchange manipulates margin requirements to crush the paper price, the physical reality of the global economy is being dismantled by kinetic forces in Mexico. The disconnect between the price you see on the television and the value of the metal required to run your civilization has never been wider. And right in the middle of that gap is a famine. Not a famine of food, but a famine of conductivity. This is the autopsy of the coming tech famine. In the latest data from the intelligence streams, we have witnessed a collision of three catastrophic vectors that the mainstream financial press is too incompetent to connect. Vector 1 is the paper crash. Silver prices have collapsed from over $121 per ounce down to the $76 to $84 range. This is a liquidation purge driven by the nomination of Kevin Warsh and a ruthless change in margin calculations by the exchange. Vector 2 is the inventory depletion. The vaults in London and New York are bleeding physical metal at a rate that suggests a run on the bank. Vector 3, and this is the lethal injection, is the kinetic event in Sinaloa, Mexico. We have confirmation that 10 high-level personnel from a major Canadian mining operation have been seized by armed groups identified as a faction of the Sinaloa organization. This is not a crime story. This is a resource war. And the victim is the supply chain for every solar panel, every electric vehicle, and every artificial intelligence data center currently under construction. Let us dissect the anatomy of this famine. The market is currently pricing silver as if it were an infinite resource that nobody wants. A 30% drop implies a massive surplus or a collapse in demand. But the physical reality is the exact opposite. The industries of the 21st century are thirstier for silver than at any point in history. You cannot build a high-efficiency solar panel using TOPCon or heterojunction technology without increasing your silver consumption by 50% compared to older models. You cannot build a server rack for generative artificial intelligence without massive amounts of silver for high-speed connectors and thermal management. Silver is the most conductive metal in the periodic table. It has no substitute. Physics does not negotiate with the Federal Reserve. Physics does not care about the spot price on the COMEX. If you do not have the metal, the electricity does not move. The data does not flow. The artificial intelligence does not think. And this is where the strategic seizure in Mexico becomes a global disaster. Mexico is the #1 silver producer on the planet. The Panuco project, where these personnel were extracted, sits on one of the largest undeveloped high-grade veins in the world. It was supposed to be the relief valve for the structural deficit that has plagued the silver market for 5 consecutive years. That relief valve has just been welded shut by kinetic force. When 10 engineers and geologists are removed from the equation by armed non-state actors, you do not just lose 10 people. You lose the confidence of the entire capital structure supporting the mining industry. Who will ensure a mine in Sinaloa now? Who will deploy hundreds of millions of dollars in capital expenditure to build a new processing plant when the local governing authority is a cartel faction? The answer is nobody. The capital will flee. The mines will go into care and maintenance. The supply cliff will become a vertical drop. But the violence in the mountains is only the trigger. The systemic rot lies deep within the financial architecture of the West, and that is what I am going to expose next. While the mines are being paralyzed by fear, the price discovery mechanism is being paralyzed by fraud. The Chicago Mercantile Exchange raised margin requirements from 11% to 15%, right at the peak of the price action. They switched the calculation method to punish holders of long positions. This forced a massive wave of automatic selling. Hedge funds and retail speculators who were betting on the debasement of the currency were forced to vomit their positions to cover their debts. This is a classic liquidity trap. It creates a false signal. It tells the world that silver is worth less, right at the moment when it is physically becoming priceless. This price suppression is the seed of the famine. At $70 or $80 per ounce, with insurance premiums skyrocketing due to the Mexican risk and energy costs rising due to the tensions in the Strait of Hormuz, many mines are now operating at a loss. They are below their all-in sustaining costs. What does a miner do when the price drops below the cost of production? They stop digging. They high-grade the mine, taking only the easiest ore and leaving the rest, effectively destroying the long-term viability of the asset. Or they simply shut down. So, the paper market crash, orchestrated to save the dollar, is actually guaranteeing a physical shortage. It is destroying the incentive to produce the very material that the green economy needs to survive. You need to understand the scale of the trap. The entities accumulating physical silver right now are not the ones panic-selling futures contracts in Chicago. They are the industrial giants of the East. They are the strategic reserves of nations that understand the difference between paper and metal. We are seeing a phenomenon called backwardation, where the cash price for immediate delivery is higher than the futures price. This is the market screaming that there is a shortage of actual bars. The vaults in London, monitored by the LBMA, have seen their holdings drop to the lowest levels since reporting began. The registered inventory at the COMEX in New York is a ghost town. The metal is moving from transparent Western vaults to opaque Eastern stockpiles and private industrial warehouses. When the inventory reaches zero, the price on the screen becomes irrelevant. You will see a bifurcation of reality. There will be the official price, which might be suppressed by interest rate policy and paper derivatives. And then there will be the real price, the price you must pay if you actually want the metal to build a missile guidance system or a photovoltaic cell. We are already seeing this with the retail premiums on silver coins jumping to 100% over the spot price. This is the street voting against the screen. This is the first stage of the famine. The second stage is when Apple, Tesla, or Samsung sends a procurement order for silver paste or bonding wire, and the supplier says, no, not, it will cost more, but no, we do not have it. That is the tech famine. It is not a famine of ideas. It is not a famine of software. It is a famine of atoms. You can write all the code you want, but without the hardware to execute it, the code is a ghost. The valuation of the entire tech sector, trillions of dollars of market capitalization in companies like Nvidia and Microsoft, rests on the assumption of a frictionless supply chain. That assumption died this week in the mountains of Sinaloa. That assumption died on the trading floor of the Chicago Mercantile Exchange. The supply chain is not frictionless, it is broken. It is being strangled by a pincer movement of cartels on the supply side and central bankers on the pricing side. The irony is palpable. The nomination of Kevin Warsh was supposed to signal a return to sound money and a strong dollar. The market reacted by crushing precious metals. But by crushing the price of silver, they are crushing the mining industry. And by crushing the mining industry, they are ensuring that the green energy transition and the AI revolution will hit a brick wall of physical scarcity. You cannot have a high-tech future with a 19th century mining collapse. The system is cannibalizing itself. It is selling the foundation to buy a coat of paint. Now, consider the geopolitical angle. We have discussed the Mexican front, but look at the shipping lanes. The Malacca Strait is clogged with collisions and dark fleet operations. The Strait of Hormuz is facing the threat of a drone carrier blockade. The cost of moving physical goods is exploding. If you manage to get the ore out of the ground in Mexico without being intercepted by a cartel roadblock, you then have to ship it to a refinery, likely in Asia or Europe, through waters that are becoming war zones. The friction costs are eating the margins alive. The global assembly line is seizing up. This leads us to the ultimate implication for your wealth. Most investors are holding tech stocks or green ETFs. They think they are diversified. They are not. They are short volatility and short reality. They are betting that the complex, just-in-time delivery systems of the globalized era will continue forever. The data from this week says they will not. When the tech famine hits, it will not look like a slow decline. It will look like a sudden cardiac arrest. A major manufacturer will announce a production halt. A guidance update will cite material shortages. The stock will drop 20% in a day, and then the panic buying of physical materials will begin. But by then, the vaults will be empty. The mines in Mexico will be nationalized de facto by the cartels, or de jure by a desperate government. And the paper price of silver will snap back like a rubber band that has been stretched across the Pacific Ocean. Do not be fooled by the drop to $76. This is a bear trap. It is a subsidy for the smart money to take delivery of the last remaining ounces of cheap silver on Earth. The smart money knows that the Warsh effect is temporary, but the geology of the Panuco deposit is permanent. They know that the cartels are not going to give back the mine without a fight. They know that you cannot print silver. This is a game of musical chairs, and the music just stopped. The people sitting in the chairs are the ones holding physical metal. The people standing around looking confused are the ones holding paper contracts and tech stocks. The narrative of the tech famine is the story of the next 5 years. It is the story of how the virtual world crashes into the physical world. The metaverse requires servers. Servers require silver. If the silver is held hostage in Sinaloa or locked away in a Shanghai vault, the metaverse stays offline. The localized risk in Mexico has metastasized into a systemic risk for the entire global economy. The blood of the 10 hostages in Concordia is not just a tragedy, it is a signal. It signals the end of cheap resources. It signals the end of safe jurisdictions. It signals the rise of resource nationalism and asymmetric resource warfare. You have been warned. The price is a lie. The shortage is real. The famine is coming. Do not remain silent. If you do not have a specific number of physical ounces in your possession, you are already a casualty of this war. You are a victim of the illusion. Write the exact number of physical silver ounces you own in the comments below. If that number is 0, write 0. Admit your vulnerability. Face the reality. Step out of the paper matrix and into the physical world before the famine takes everything.